vielen Dank. Hallo und grüß Gott München. Hallo Deutschland. Herzlich willkommen auch im Namen von Morgan Stanley Investment Management. Und wenn man so die letzten, sagen wir mal, 3 Jahre sich anschaut an den Aktienmärkten, hat man das Gefühl, das war so ein 0- und 1-Spiel. Ne? Also entweder man hat auf wachstumsstarke Unternehmen gesetzt oder vielleicht dann, so wie im letzten Jahr oder auch jetzt, vielleicht mehr auf Value. Man könnte meinen, das ist relativ einfach, da auf den richtigen zu setzen. Und dass es da einen dritten Weg gibt, der nicht unbedingt auch eine Mischung aus beiden ist, sondern was ganz Besonderes, auch was sehr Bewährtes über viele Jahre, wird Ihnen meine Kollegin Candida de Silva, nochmals willkommen, von unserem International Equity Team berichten und erzählen. Und zwar mal kurz hier im Saal, Hand hoch, wer kennt den Global Brands Fund von uns? Ja, die große Mehrheit, genau. Und aus diesem Team ist Candida. Wir haben aber auch einen anderen Fonds, der auch zurzeit sehr gut in die Zeit passt. Und ja, Candida ist bei uns Senior Portfoliospezialistin und wie es für einen anständigen Vertriebsmann und Gentleman einer englischen Dame gegenüber auch sein sollte, überlasse ich den Großteil der Arbeit dir. Und Fragen dürfen Sie auf Deutsch sprechen, obwohl wir auf Englisch den Vortrag machen, weil Candida auch Deutsch versteht. Also in diesem Sinne, viel Spaß.
Thank you very much. Thank you very much, Jahre, and it's a pleasure to be here and to see you finally in person after nearly 3 years of virtual working. So forgive me, clearly this is the first time I've spoken at a conference for some time because I completely forgot I need to wear an outfit that allows me to have a microphone. So I'm going to stand here rigidly and talk to you. The second fallout of COVID is that I now need to wear glasses. So I'm going to be doing that annoying thing of putting my glasses on and off. Yeah, seriously, it's a pleasure to be with you today. And as Jahre said, what I'd like to talk to you today is about a third way, possibly, which is quality investing and the role that quality funds, and specifically our quality approach, can have in your portfolio, particularly against the backdrop of such a challenging market environment. Global Sustain is the sister strategy to Global Brands, as Jahre mentioned. And Global Brands is a philosophy which we have been running for 25 years. So we've done so consistently, and it has delivered strong out-compounding over time, so outperformance over time, but particularly by focusing on minimizing downside risk in difficult markets and delivering steady returns over that period. So let's see if this works. How does this work? Okay. So I know today you've had a lot of discussions on macro events, so I won't linger here, but if I think about this year, it's been an extraordinary ride. It's obviously been extremely difficult for investors, and the MSCI World is down 20% since the start of the market. And it really feels like this quote from Lenin, from another Vladimir, is actually apposite. There are decades when nothing happens, and there are weeks when decades happen. When we think about COVID a few years ago, when it hit, we as a team, of course, first of all, looked at our existing portfolio, and we were comforted that we had to make no forced sale, and the balance sheets of the portfolio of the companies we held were robust. Another thing we did, though, is we took a look out. We are bottom-up investors, but we wrote a piece called the COVID Accelerator, and this was in May 2020, and we wrote about the trends that we thought we might be seeing due to the pandemic. And indeed, they came to bear, and they actually benefited the portfolio. So we saw an acceleration of digitalization. Think about Microsoft, Satya Nadella, saying that he was seeing digitalization 2 years' worth happening in 2 months. We also saw a trend towards the need for healthcare and diagnostics, and then a shift from cash payments to card payments, which benefited our portfolio, given we have exposure to the likes of Visa. But what's happening now, of course, is we've had another Vladimir accelerate trends that were already happening in the market. So we already had supply constraints in commodities. We already had a trend towards deglobalization and reshoring of manufacturing. And then we had, of course, now this critical issue of energy security that we've just spoken about, and inflation, all against the backdrop of a cost of living crisis that is putting a squeeze on the consumer. So where does that leave investors? Today, obviously, where we're sitting just in the beginning of July is a slightly more comforting place when it comes to valuations. We were very nervous at the beginning of the year, given the absolute level of valuations. We've seen this sharp derating, which of course has been difficult for investors, but nonetheless it does mean at least that valuations are now just about 3% above their average from 2003 to 2019. So really for that period since the dot-com bubble, aftermath of the dot-com bubble before the COVID pandemic. But what we haven't seen yet is a fall in earnings, and that's what's making us nervous. And of course, inflation is the new preoccupation of the market. So we're not macro specialists, we are bottom-up investors. But today, we are cautious. So we think the market is vulnerable. Even though multiples have come down, we do think that earnings are looking very stretched. We also know, as I say, that inflation is an issue. What does that mean? Pricing power really matters. And that's where our portfolio comes in. And of course, ESG is a topic I know you've been speaking a lot about in Germany. And I indeed spend a lot of time thinking about it as well in terms of how we can make sure that our products are relevant for you. But the truth is, companies now are under much more pressure from governments, from regulators, and from asset owners to think about ESG risks and disclose better. And so ultimately for you as investors, what matters is there's no single way to think about ESG, but what you want to be sure is that your investment manager does it in a way that is authentic to their own investment process and makes sense, and that you understand it. So today is all about seeking resilience by investing in high quality. What do we look for when we talk about a high quality company? So this is our very, very simple compounding wheel that has remained the same for those 25 years. First and foremost, we're looking for companies with dominant, sustainable and intangible assets. What do we mean by that? We mean networks, for example, Visa with its payment system all around the world. We need subscriptions, the likes of Microsoft or SAP, increasingly now on the cloud, generating that recurring revenue stream from their clients, whether that's the consumer or whether that's businesses. And then we mean brands. So we invest in the likes of Nike, of L'Oreal, of Reckitt Benckiser, who has a very strong portfolio of brands that are well known to the consumer. This gives them the moats, the high barriers to entry, and maintains their market share. In today's world, I've talked about this, but pricing power, of course, really matters. Currently, we're seeing probably most companies pass on the input price costs. But actually, what really matters is when the push comes to the shove, what's going to be happening in terms of businesses that are more commoditized. Are consumers going to be prepared to pay for that price versus those where the brand or the service is a must-have? And so that company then can pass on responsible price increases. And we look for companies that are not capital intensive. We don't invest in the more capital intensive parts of the market. We certainly don't invest in energy and the extractive industries. And indeed, with this fund, we also have some formal exclusions in place to make sure that it is fossil fuel free. What matters, of course, is cash. With cash, you can do something, you can reinvest back in the business. And that's what we're looking for, is strong management in the centre that sensibly allocates capital to the durability of the franchise going forward. And this is the result. I've given you here global brands, otherwise known as global franchise, above, because that has a longer track record. And really you can see this compounding over time. What we're looking for is that steady compounding of earnings, which can then in turn deliver for our clients' outperformance. And Global Brands, since inception, has delivered per annum excess returns of 6.5% since 1996. What matters for us is earnings. We think there are two ways to lose money. The multiple goes away. We've talked about the derating we've seen, but also the earnings go away. And Global Sustain is a shorter track record than Global Brands, but you can see that despite what's been going on recently with the earnings of the market sharply accelerating following vaccine discovery, is nonetheless Global Brands' earnings have out-compounded the market. Why? Because when COVID hit, yes, the earnings fell, but they fell much less than the market. And as you can see, they accelerated quickly and came back to their previous high water mark quicker than that of the market. In terms of sector allocation, ultimately we're bottom-up stock pickers, but what you end up in terms of where we find these high-quality companies is particularly focused on three sectors: information technology, healthcare, and consumer staples. But what really matters is where we fish within those three sectors. So information technology, we're less focused on the growth names. We don't invest in the FANGs. Where we're focused is in possibly the slightly more boring, recurring revenue generator companies, those in software and services in particular. So we invest in ADP, which is an employment payroll provider for US businesses. Really crucial to those businesses because it's really complex tax efficiencies that they need to try to deliver. And these companies need to just make sure that ADP is going to continue to deliver that service. Visa, Accenture, Microsoft, SAP. And then healthcare, what we don't do is invest in pharmaceuticals. We think that they are more at risk of patent cliffs and indeed of political meddling potentially. Where we find opportunities is in life sciences. So we invest in Thermo Fisher and Danaher, and also in more consumable med tech and equipment. For example, needles and syringes into hospitals, saline drips, sterilization equipment. All these things are crucial no matter what's going on with the economy outside. These hospitals, these patients, these scientists need these capabilities. And then within consumer staples, you can see some very well-known names there. You can also see we're not in the not owning business. Not only do we have exclusions in a number of sectors, but these sectors at the bottom don't meet our quality criteria. And then within financials, we don't invest in banks. Where we find opportunities is in credit ratings agencies, credit scorers, and then, as you can see, high-quality stock exchanges. Why does this matter? And when we look back at the global financial crisis, which does seem quite a long time ago, but unfortunately also seems a little bit too near now, you can see these three sectors in the gold where we play is actually are the ones that proved the most resilient in terms of earnings. And arguably, in terms of software and services today, given more of their businesses are now on the cloud, you could say, in fact, they could be more robust than they were at that time. Now, these brands are well known to many of you. This is the point, I guess. These are brands that are part of our daily lives. We tend to prefer the same shampoo. We use the same face cream. We go for the same washing powder. These companies can make small innovations that make us further attached to the brand. But ultimately, these are not huge capital outlays for us as consumers, but we do tend to have a preference for particular brands. And furthermore, these companies have really continued to invest in digital marketing, which has become more and more important, obviously, under the pandemic in terms of social distancing. This picture doesn't give the med tech and the healthcare names because they're less well known to the consumer. But of course, the story is the same when it comes to hospitals, vets, and scientists needing these same brands and trusting these same brands. Now, pricing power is something you'll have heard lots of people talk about. And what we really look for in terms of the companies that we own is genuine pricing power. And also, our belief is that by having high gross margins, it enables them, even if they have to pass on the price, they can do so at a lower rate than some of their peers, because to defend their gross profits, given their strong gross margins, they don't need to hike the price up as much as their peers may be. Now, on the right-hand side, you can see a slightly maybe cynical take on other ways in which companies today can help, I suppose, make the consumer feel like they're not having to increase their price. But of course, that's by making the packaging smaller. That doesn't feel like it's going to be a sustainable option, but it is something certainly we are all seeing. And indeed, I would say another trend potentially you're going to start seeing is skimpflation, which is where you see companies reducing the services that they offer. But that's not something that we are specifically looking for here. So it's not just theory. This, you can see, is the gross margin of Global Sustain and, importantly, the margin stability. Because companies with higher gross margins overall have had more stable gross, so with more stable gross margins who've been able to have better pricing power. And here are some examples in practice that we've seen and we've heard from the companies that we invest in. Reckitt Benckiser passed on responsible price increases of 5% in the last quarter. Microsoft effected its commercial product price increase in March this year. And then on the healthcare side, again, these products, these services are so crucial that, again, when we're looking at Danaher and Thermo Fisher, they were able to increase their prices by 2%. And then look at someone like Visa. Actually, they benefit from the higher prices on every transaction, indeed, as well as increased merchant fees. What matters to us, as you can see, is quality. And here you can see on the left-hand side the quality metrics of this portfolio. That's what really counts. And we're seeing here a much higher return on operating capital employed than the market and a much higher gross margin, not at meaningful debt levels and at lower capex levels. Yes, we pay a premium for this portfolio. We do pay a premium for quality. But for us, what really matters is that price to free cash flow premium, which is lower than that of the price to earnings premium. Now, the expectation for performance of this portfolio is that we're unlikely to capture 100% of the market's upside, particularly where you have a value or a cyclical rally, or indeed a growth rally. We don't own parts of the market, and as I said, for example, we're not investing in energy, so you look at performance this year, of course that's had an impact. However, where we're really focused on is trying to minimize that downside participation. Now, again, given Global Sustain is only 4 years old, and obviously it's got a much shorter track record in terms of what we can show over time, it is interesting to look at what this figure is for global brands. And for global brands, which has been going a lot longer, we've got 82% upside and a 55% downside capture. And you can see, in terms of calendar year, there are periods where it really matters. And if you look back in 2020 for this fund, the market fell and this fund fell 7% less and recovered much more quickly. So I've talked about the resilience. Now, what about strong on engagement? We're very lucky, frankly. We're bottom-up investors. We run concentrated portfolios. And we also own the companies that we hold for the long term. We also run $60 billion in assets across the team. This means that we can properly have conversations with company management. We can have access to company management repeatedly. And indeed, our belief is it's something that we shouldn't outsource to another team at Morgan Stanley, but we should be doing it ourselves. So our portfolio managers are the ones that not only conduct the ESG analysis of the stocks that they know well, it's another factor alongside their financial factors for them to look at, but they are also the ones that have the conversation with company management. But first of all, just talking about product labels. I know it's important to you now in Germany, and it's increasingly important for all of us, of course, in terms of what's going on with SFDR and all the other regulations that are now abounding. This fund is an Article 8 fund. Indeed, all of our funds are Article 8. But Global Sustain, as you can see, has a broad set of exclusions, particularly in terms of fossil fuel. You can see it not only excludes the carbon-related sectors entirely with a zero tolerance, but in addition, we then have an additional carbon filter where we exclude the highest carbon emitters from the remaining universe. What we end up with is at least a 20% reduction in the initial universe before we then look at the other sector and industry exclusions. You can see those exclusions here. We have a 10% revenue threshold for all of them, but for tobacco, we have a 5% revenue threshold, which again, I know is important for the BVI criteria. And then, of course, we also monitor business practices and controversies. In terms of ESG integration, which frankly is a little bit more interesting, this, as I said, is the responsibility of our portfolio managers. Ultimately, this is going to be a focus, first and foremost, on whether we think there are any material ESG risks to the sustainability of the returns on operating capital of these companies. Do we think that that franchise durability is there? Do we think there's anything that could impair that ongoing return on operating capital? But what we have done is we have set ourselves our own proprietary framework in order to provide some kind of framework that is common for all of the portfolio managers to use as they conduct this analysis. Yes, we use some third-party data providers, but we're not seeking to deliver a particular ESG rating from MSCI or from Sustainalytics. This is a stock-by-stock approach based on the portfolio manager's assessment. You can see there's a number of universal risks we look at, whether that's carbon, diversity, pay. Of course, these are common across all companies. And then there's industry-specific risks. So, for example, healthcare, crucial, of course, is product safety. And for us, that's the material ESG risk that we're really looking to make sure we don't have a meaningful concern about. And then there are company-specific risks. And, of course, there are also some opportunities. However, I'll be really clear, this fund is not an impact fund. You can see we're not investing in startups or renewable energy companies. I think that's really exciting, and there are other parts of the portfolio, your portfolio, that you can do that with. This portfolio, as you can see, is investing in established players. However, within that, you are going to find sometimes there are some ESG opportunities in terms of businesses, products and services that our companies offer. If you think about L'Oreal, DNA is embedded in their approach. They've been extremely innovative in terms of very early on measuring the carbon footprint of every single one of their products, obviously using it as well in terms of better labeling for consumers, and then within their underlying brands as well, having specific missions to become, more environmental and more sustainable. And a few examples, they have a 100% target of recycled plastics by 2030. They're innovating to have shampoos with less water, etc., etc. And then SAP is a company, a German company, obviously, that's benefiting also from parts of its business offering better capabilities to their clients to be able to measure and disclose on ESG matters. And engagement for us has three threads. First of all, as I said, we think it should be conducted by the portfolio managers themselves who know these companies. Secondly, we think this isn't just about jumping on the latest bandwagon or the latest fad. We think it should be comprehensive, and you can see this is the data from 2021 where we engaged across a range of issues depending on what was relevant for that particular company. And third, we think it should be deep and meaningful. Last year, we specifically conducted an engagement program on decarbonisation. We did some analysis on every one of the companies in our portfolio, and we, first of all, wanted to understand those that didn't have targets, why they didn't have targets. So we went and discussed with them. In many instances, they were trying to work things out. And indeed, we've already seen an improvement in terms of those that now have targets. For those that had ambitious targets, we also wanted to understand how are they going to achieve this. And so together, we managed to engage with 95% of the portfolio in all our, across our global portfolios on carbon, which is really substantial when you think about the industry average as being 19%, according to the UN PRI. And here's an example of a couple of engagements that we have conducted. And indeed, I think on your tables, you will see we write a biannual report with some examples of the engagement we have conducted. Ultimately, our view is this is iterative. It's a marathon, not a sprint, and it takes often multiple conversations with company management. But here you can see, for example, with Roper, they are ultimately a software provider. They sit in industrials, but they're very carbon light. They didn't think carbon was an issue or indeed that important. But we went to discuss with them and we said, look, we think it is increasingly important. The regulators mind this, your asset owners mind this, and it's important that you at least have a plan. What was great about this is they actually listened and they asked us then to come back. They appointed an ESG consultant and they asked us then to have a conversation with their consultant to better understand what we see as best practice and what they might be able to do. So we've got many other examples in our newsletter. And then finally, the third pillar of this fund, built on quality, strong on engagement, is light on carbon. This fund has a second non-financial objective, which is to have a significantly lower greenhouse gas emissions intensity than the broader market. And you can see that it does. So when we look at the more controllable emissions, which is Scope 1 and Scope 2, it's 84% lower on per $1 million of sales. When you look at the per $1 million of invested, it's 95% lower. Scope 3, of course, is meaningful for some companies, consumer staples companies particularly, thinking about their suppliers upstream and then the consumer downstream. And of course, we're engaging on that too. And this is the result of our analysis that we've done in terms of our decarbonisation engagement programme. So you can see already in that short time, not only did we have more companies set targets that had initially not had targets, but also we saw an improvement of those that have more ambitious targets. So now 70% of the portfolio has net zero targets versus 46% earlier this year. So that's really it. We write a lot. You're very welcome to come and have a look at our website and see some of the insights. But I think if we just summarise, this portfolio is strong on engagement, light on carbon, and built on quality. In our view, of course, the environment is extremely challenging, but by focusing on companies that have resilient earnings, regardless of what's going on with the economic cycle, that have brands which consumers want to use and have this recurring revenue stream, we think is a really meaningful, helpful way of trying to get through the slightly cloudy passageway ahead, but also, frankly, an opportunity for long-term investors to hold in their portfolio for the long term. So with that, I'll take any questions.
German or English is welcome.
Wer will als Erster? Sonst muss ich es wieder machen. Da mache ich es auch. Und zwar bei den hohen Ansprüchen, die ihr ja stellt an die Unternehmen von der Qualität her, von der Visibilität, Resilienz und. Ist immer interessant auch zu sehen, was so vielleicht die letzten Monate an interessanten Gelegenheiten gebracht haben. Was sind so Unternehmen, die da, sagen wir mal, aufgefallen sind und wo man vielleicht dann auch sich entschlossen hat zu investieren?
Yeah, thank you. I mean, of course, with every difficult market environment comes some opportunity. I think if we think about the last 3-4 years, we spent an awful lot of time worrying about valuation and constantly trimming the more growthy aspects of the portfolio and the slightly more expensive parts of the portfolio and ploughing those profits back into the less expensive, less richly valued parts of the portfolio. But in terms of new opportunities, we found some interesting ideas. So one is Broadridge Financial Services, which is described by Forbes as the best financial company you've never heard of. And that does proxy voting, and it has a 95% market share in the US, and it has an extraordinary client retention rate of 98%, extremely high return on operating capital employed, and it does the messy administrative stuff that many companies don't want to do. And so, you know, some people describe some of the companies that we hold as boring, but boring is okay, frankly, if it's needed. Another example is Steris, which is a disinfectant and sterilization company, again, crucial to hospitals, very, very high market share. More recently, when we're looking at the first quarter of this year, we did have an opportunity as well to buy back some of our companies on derating. So where we still have conviction and the companies derated, such as Danaher, then we also added to those positions. Thank you, Božidar.
You're welcome.
Jetzt, Sie haben uns gerettet.
Vielen Dank für den interessanten Vortrag. Ich habe mal folgende Frage. Haben Sie denn KPIs von Ihrem Fonds möglicherweise verfügbar, insbesondere die Dividendenrendite bezogen auf das Portfolio und vielleicht Gewinnwachstum, Earnings Growth? Und haben Sie vielleicht schon eine Analyse gemacht, ob Sie das zum Jahresende oder auf Sicht gegebenenfalls ein Stück weit nach unten revidieren würden oder müssten?
So let me just understand that. So you want the dividend yield of the portfolio and the earnings growth of the portfolio?
Yeah, and if you have to put it down a bit.
Yeah, if the expectation
the expectation as well. That's what I thought you were asking. So in terms of the dividend yield, it's not enormous, but it's okay. I think it's 1.8, I think. Let me just put my glasses on.
And stable, usually. Yeah.
Yes, so it's actually, more recently it's 1.3. In terms of earnings growth, I don't have the number right now because things have changed a little bit, but I can certainly come back to you. In terms of expected returns, frankly, I'm not sure. It's not our job to time the market, and obviously we've seen absolute numbers come down. However, through to the end of June, certainly this last quarter has been more constructive for the portfolio, and we've delivered outperformance versus the market. I think just in terms of attribution of what's gone on this year, there have been a number of factors. So not having energy, of course, has been a detractor. Having an overweight to information technology has also been a detractor. However, stock selection within information technology has been positive, and also having a very low consumer discretionary exposure has also been positive. On global brands, where we have a higher consumer staples weight, because we own some tobacco, we own Philip Morris, and we own a number of alcohol companies, which are not held in here, the performance year to date has been slightly stronger because we've had a little bit more of that defensive consumer staples exposure, which obviously has been helpful given the current market. In terms of where we go from here, our team is cautious, I have to say, and does think the market's vulnerable. So when we have done the analysis of what happened with the global financial crisis, what happened was rather similarly, we had a derating of the multiple, and the earnings of the market still continued to march upwards. And then when the earnings of the market started to fall, that was the point at which this portfolio or global brands then sharply outperformed. And that was because its earnings fell dramatically less than that of the markets. And at the moment, obviously, we're not at that point yet. If we're learning anything from history in terms of that kind of march of the market's earnings. And I think that's what we're concerned around in terms of absolute levels. So we spend our time focusing on really testing, the portfolio itself and checking that it's robust. And obviously, we've continued to see very strong results from these companies.
Also für den Markt insgesamt scheint es uns, die Gewinnerwartungen sind noch viel zu hoch. Das kann auch für einige unserer Unternehmen sein, aber grundsätzlich ist die Resistenz oder auch dieses Downgrade bei Unternehmen bei der Qualität typischerweise nicht so scharf wie bei einem im Markt. Okay.
Yeah.
Dann vielleicht eine letzte Frage noch. Tatsächlich, freut mich.
So I've got two questions. One is the portfolio is fully invested at all times, or?
Yes, so we have about 2% normally in cash, just to obviously give us flexibility.
So and the second one is regarding the governance. Have you ever been invested to Wirecard?
No. And nor Shopify or Netflix or any of these others that, no. That was a simple answer. Thank you all.
Vielen, vielen Dank. Auch dir ganz besonders natürlich. Einige Unterlagen sind auf dem Tisch, auch ein schöner Beutel, wo Sie das alles zusammennehmen können. Badesaison kommt, hält was aus der Beutel. Viel Spaß und bis später dann noch.